Hi everyone, welcome back to the channel. So this video is going to be taking an in-depth look into why Seritage Growth Properties is a stock that could represent an undervalued opportunity at its current price of roughly $11 to $13 with a market cap of approximately $700 million. We'll be going over some of the redevelopment projects that they're currently working on, the company's financial position, the debt held by Berkshire Hathaway, and of course, Seritage's moat or competitive advantage. Also, we'll be going over why some value investors had previously bought into the stock when it was in the $40 to $50 range. Hopefully, you're interested in commercial real estate and in knowing how the stock will grow over the next 5 years to give its investors a multi-bagger return. So I came across Seritage Growth Properties when Tom from the Investing with Tom YouTube channel mentioned Mohnish Pabrai recently filing a 13G after taking up a position in Seritage Growth Properties. Now, I've followed Pabrai for a while now, so I thought that this is an investment filter that makes Seritage a worthwhile opportunity to look into and try to understand. We know that Mohnish would not be looking into buying into Seritage at $9 to $11, only for the stock to go to 15. So let's go through the background of the company. After being spun off from Sears through a rights issue in 2015 with a portfolio of 266 properties, Seritage developed a three-pronged strategy to capitalize on the real estate portfolio that they had inherited from Sears. Firstly, to sell off dozens of smaller market assets to raise cash. Second, to gradually subdivide the majority of the Sears and Kmart stores in its portfolio to bring in new tenants paying higher rents up to 3 to 4 times higher. Third, to redevelop prime trophy assets into mixed-use centers or premier retail destinations. Great. Next, let's analyze why value investors such as Warren Buffett, Mohnish Pabrai, Guy Spear, Phil Town were buying into the Seritage Growth Properties stock when it was trading at around $40 to $50 per share. So as per the 8K released on April 9th, at a portfolio level, the total cost basis, which is the original cost plus the capital invested to date, is less than $95 per square foot. This provides a solid foundation for the next stages of investment and redevelopment. Essentially, what they're doing is taking the real estate portfolio that they had inherited from Sears at a value of approximately $2.7 billion, redeveloping and releasing the space to new tenants at a rate that was 3 to 4 times higher than what Sears and Kmart were currently paying. Even if the entire project took 10 years, say from 2015 to 2025, and up to $3 to $4 billion in debt, the valuation could at least be 5 times higher, giving it a market capitalization of $9 to $12 billion. The compounded annual growth rate that the investors could have achieved from this investment would have been 15 to 20% per year over the next 10 to 15 years. To get an idea about the projects that they're redeveloping, let's take a look at their redevelopment pipeline. We'll be looking at 4 projects that they had announced in the latest 10Q. They are number 74, number 92, number 161, and 169. Let's go through the first project, number 74, the North Harlem Avenue project. So the City Council of Chicago had approved plan for the developers to make a 5-story building, which includes 161 rental units, ground floor retail, a national grocery store, a health club, 462 parking spaces. They expect this project to be completed by 2022. Currently, only 11% of the gross leasable area is leased and the tenant is Sears. Around the property, we can see that there's a Walgreens, a CVS, and a Starbucks. The population within 10 miles of the project is roughly 2.7 million people with an average household income of $99,000. The second project that we're looking at is number 161, the Park Heritage Dallas project. Here, the existing buildings will be demolished to create 2 million square feet of residential, retail, office, and hotel development. They expect the project to be completed around 2022. Currently, only 22% of the project's gross leasing area has been rented, and the tenant is Jared Jewelry. Around the project, they have a Target, AMC theaters, a country club, and a lot more attractions. The population within 5 miles is 389,000 with an average household income of $117,000. The third project is Heritage Place project. The proposal calls for redevelopment of approximately 13-acre site for mixed-use development that includes 210 rooms, 500 multifamily units, 2,245 stalls for underground parking, 23,000 square feet in retail space, 100,000 square feet in street-level retail space, and 266,000 of office space with approximately 2.1 acres reserved for parks and open space. They expect the first phase of this development to be completed by 2023. Around the property, we've got a Microsoft Office, Trader Joe's, Jack in the Box, to name a few. The population around this property is around 250,000 with an average household income of $165,000. The redevelopment projects are relevant when we're looking at the competitive advantage and moat of Seritage, but before that, let's take a look at their debt. Seritage has an outstanding debt of $2 billion to Berkshire Hathaway. $1.6 billion had initially been given to commence the redevelopment projects. The term loan facility includes certain financial metrics to govern collateral and covenant exceptions set forth in the agreement, which I put in a screenshot on the screen, so if anybody's interested, they could just pause and read into it. The term loan facility also provides $400 million incremental facility that could be accessed subject to Seritage earning more than $200 million from non-Sears tenants, and in good faith continue to earn at least $200 million in the next 12 months. The biggest advantage that Seritage has when it comes to its debt is the fact that it just has to deal with one counterparty run by arguably the best value investor ever, who himself is actually a shareholder in Seritage, Warren Buffett. So despite the setbacks that Seritage has encountered this year, it continues to pay 7% annually on Berkshire Hathaway's $1.6 billion term loan, plus a 1% commitment fee on the $400 million of potential additional funding. That's nearly $30 million a quarter in interest income for Berkshire Hathaway. Currently, Berkshire has agreed to allow Seritage to defer the interest payments if its cash balance falls critically low later this year. Let's go over Seritage's moat or its competitive advantage. As we can see from the properties they have in the redevelopment pipeline, Sears outlets are positioned in neighborhoods that are densely populated, where the average household income is above average. Apart from that, the infrastructure, such as roads and accessibility, connection to highways, bridges, and so on, have already been built. Redeveloping the Sears outlets is in the best interest of the community that they currently exist in. Redevelopment not only increases the economic activity in the community, but it also provides permanent jobs to individuals living there. Since the properties being developed are of top quality, they tend to increase the land value of other properties around it. It increases the economic activity and could also serve as an incentive for larger companies looking to expand, such as Amazon, and to set up offices within those communities, which in turn increases the demand for residential units made by Seritage. So Seritage's competitors can't enter the same community and build a similar structure due to regulatory barriers of entry. It's in the best interest for them to form joint ventures with Seritage, and these partnerships are not only a source of income for Seritage, but also cut the cost of redevelopment, since half the cost will be funded by the counterparty in the joint venture. The community they own properties in have every incentive to increase the productivity of the asset, the Sears outlet basically. Let's take a look at where Seritage stock could be in the next 5 years. I'd like to assign probabilities to the scenarios that I think could happen. So a 5% probability that the stock actually goes down 50% because Berkshire Hathaway refuses to defer its interest payments and Seritage's cash burn can't be supplemented since the company is not able to enter in any joint ventures or sell any of its existing properties. I'd give a 20% probability that the stock triples in 5 years to approximately $35 a share. In this scenario, some of the redevelopment projects have been delayed. Assets were sold below the expected value, but the company is still executing the same plan. 40% probability that the stock returns a 10x. This would be in line with the original timeline from 2015 to 2025. The plan, if executed as planned, would increase the value of the properties, then valued at $2.7 billion to 3 to 4 times higher. Also, the shift from being a typical mall REIT to a mixed development REIT may justify a higher PE due to the cap rates being higher and higher annual base rent that could be charged per square foot. 35% probability that the stock is higher than a 10x. This is an extremely bullish case where a partnership with Amazon is announced. Redevelopment projects are all accelerated. New joint ventures result in property rates being much higher than expected. I hope this video was informative and helps you understand the company Seritage better. I'm looking into actually writing an entire paper and discussing individually what the properties are worth. Let me know in the comments below if you'd like to see the paper or if you'd like it to be a video in the future. If you found the video helpful, do hit like, hit subscribe, that helps out the channel. And thank you for watching.